Hey, it's Jim, and this is level 1 of the CFA program, the topic on economics, and the learning module on the firm and market structures. Back in the old days, the CFA Institute used to present its candidates with a handful of massive readings on microeconomics, macroeconomics, and then some international trade reading. What it has done now is it has chopped those topics into 7 or 8 much more palatable learning modules. And what we'll see is there's a sprinkling of micro and a sprinkling of macro embedded into each of these first couple of learning modules. And then we'll spend, the last 3 or 4 on the international trade and currency valuations and exchange rate determinations. But our focus here on this one is on market structures. So we're going to take a look at a firm, and we're not going to take a look at a firm in isolation, which we might do a little bit, at least as an introduction, when we hit the corporate finance topic, and we'll talk about things like net present value and internal rate of return. But we're going to take a look at this firm in the context of its competition and in the context of its industry. And so that's what that term market structure simply means. What is the level of competition? Is there just one firm out there? Maybe we'll call that a monopoly. Or are there a million firms out there? Maybe we'll call that perfect competition. So we have these extreme ends of the market structure spectrum, and we're going to take a look at how firms operate inside of that spectrum. We'll go ahead and start with some break-even and shutdown points, economies and diseconomies of scale, and then that second LOS. There are the 4 types of market structure. So that's pretty much the emphasis of this learning module. And every other question, go ahead and look at supply and demand, optimal price and output, limits and concentration measures. Those all relate to those 4 market structures. So let's go ahead and start with a break-even analysis. And this is super simple stuff, right? What is break-even? It means that you're not making any money. And what does that mean, not making any money? Students give me that answer all the time, and I'll say, tell me what you mean by not making any money. And so then students will say, and I bet you candidates think in a similar fashion, all right, let's talk about profit. We have revenues and we have expenses. And so a break-even point is when those 2 are identical. So look down at that third arrow point. When a company's total revenue equals its total cost, or its average revenue equals its average total cost. Now, in the problems at the end of this learning module, and there are 12 or 13 of them, I think there's one in there that asks you to go ahead and kind of prove that there is 0 profit, or we're operating at a purely break-even point. If you have to do any math, it'll be like 100 minus 80, or 100 minus 100, or 100 minus 120, something like that. So I don't think the math is really too difficult, but skip up to that very first arrow point. This is important. Economic costs compensating all factors of production. So think about all the stuff on the left-hand side of the income statement. We have all those inputs and all those costs. In the financial statement analysis, we'll call those expenses. Economists tend to call them costs, but that includes capital. So what do? When we're a firm, we borrow money. Where do we get it from? We get it from a bank. We get it from bondholders. Well, we call that debt financing, or we can get it from the owners of the business. We can get it from the shareholders. We call that equity financing. So those economic, those economic costs have to include compensation to the providers of capital. Also look at the second orange point there. This is important. Total accounting costs, I mentioned those just briefly, but also any implicit opportunity costs. We did lots and lots of discussion on opportunity costs back when we did that first topic. So let me just quickly remind you, an opportunity cost is the cost of not doing something. I say this to my students all the time. I say this to my children when they say something like, hey, you know what? I went out and I spent $3.99 on a Fortnite skin so that when I'm playing my video game of Fortnite, I can look cooler or whatever that means. And I always say, you know what, $3.09, what else could you have done with that $3.99? Surely, from my perspective as an adult in his 60s, I probably don't want to spend $3.99 on a Fortnite because I don't play video games. All right, let's go ahead and start with the left end of the scale. Let's call this perfect competition. And I'm going to give you an example here. So go ahead and pause and take a deep breath and listen to my story. What I want you to do is I want you to envision a park. Let's just suppose it's a square park. And inside of this park, there's all sorts of fun stuff that go on for, let's say, a week's time period. There are soccer games, there are basketball games, there are music concerts, there's arts festivals. Anyway, so this is called, the week of having fun. And so this is in a city, so the people go down to the park and they do all this fun stuff. Now, in the perimeter of the park, there are trucks. And I want you to imagine trucks lined up one after another around the park, and they're all selling one good: snow cones. I'm assuming this park, it's in the middle of the summer and it's 110 degrees outside. So perfect competition, what does this mean? So we have, how many could we fit around there? Say there are 100 snow cone trucks. There's my truck there, Jim's snow cone. There's Betty's truck over there. There's Jenny's. There's Johnny's. There's all sorts of trucks around there. All right. So perfect competition. We're all selling the same good. What do? We have a plastic cone, right? And we plop some crushed ice into it, and then we pour some orange or cherry syrup in there, and so we charge an amount. Let's just suppose it's $1. So the people inside of the park, they have their choice. They can go to any one of these 100 trucks to get a snow cone. This is called perfect competition. So notice the blue line there, that's horizontal. That's parallel to the horizontal axis. It's the price, it's the marginal revenue, it's the average revenue, it's the demand curve. So what did I say? Suppose that price is $1. Now, what perfect competition means if the demand curve is perfectly elastic, that means you could sell, go back to the origin, you could sell one for $1, or you could sell 1,000,000 or 1,000,000,000,000 for $1. That means that's what perfectly elastic means. So, of course, you would have no incentive to raise your price. If I'm Jim, I'm not going to raise my price to $1.20, right? Because I'm not going to sell any at $1.20. I mean, people are going to look at me and they're going to say, Jim, I can get the same cone, the same snow cone right here for $1. Why would I pay you $1.20, right? So there's no reward for raising the price. And then you wouldn't lower the price to let's say 80 cents or 90 cents because you wouldn't sell any of those and you wouldn't cover any of your costs. All right, so horizontal blue line, perfectly elastic. Well, how many are we going to produce? Well, what we're going to do is we're going to look at these 100, right? How many snow cones can we make during the course of the day? I don't know. Can each truck make 1,000 of these? What's 100 times 1,000? Whatever that number is, right? Well, we have costs, right? We have a truck, so we had to buy the truck, and we had to pay our labor, right? We had to pay ourselves. Let's just suppose we're in there doing it by ourselves. We provided the capital, so there we go. We have to buy the syrup, right? The orange and the cherry and the blue and the vanilla and whatever other colors that we have. And we have to buy the ice. I mean, maybe we could go to our mom's house and say, hey, Mom, do you have some crushed ice there? But anyway, we have to compensate our mother somehow. So we have all of these costs. And so look at that first little smiley curve there at the bottom. That's the marginal cost curve. Marginal cost, of course, is the cost of making one extra snow cone. What we're going to do is we're going to produce an output where our marginal cost is equal to our marginal revenue. In this case, is equal to our demand, and that price is going to be $1. So that's the price. In perfect competition, none of us can influence the price, right? I went through that just a little bit ago. And so there's our quantity, Q star. That's how many that we're going to produce. So how many can I do in my truck, and then how many can everybody else do in their truck? So that's perfect competition. And that means that the price is given because there are tons and tons of people out there selling the same product. Now, what happens if we have imperfect competition? So now let's change the story. Let's keep the square. Let's keep all the people in there playing soccer and listening to music and buying art. But instead of having trucks lined up after each other, let's put a truck on each corner. And let's suppose that the distance between each corner is, I don't know, let's say 5 blocks, just so we have to put some distance. So we have 4 people now, 4 trucks selling the same snow cone. Oh boy, so this is not perfect competition because now the people who are there consuming snow cones, they have to make the decision that if the price is going to be different between my snow cone and, let's say, Betty's snow cone all the way over there, they have to factor in, I need to walk all the way over there, right? And maybe they have some children and they have to push, and they have children running over there, and they're thinking, there's no way I'm running over there to get a lower price. I'll stay here and I'll pay a different price. Maybe I'll pay a higher price. So under imperfect competition, here, let me go back here. This is where the marginal revenue and the price and the demand, this is where these things kind of separate, right? The marginal revenue in this case is going to be equal to the price because when I sell, every time I hand a snow cone out there, I sell it for $1 and they give me $1. That's the price, and that's my extra revenue. That's my marginal revenue. And remember, I have no influence over the price. But here, the demand curve, so look at that flatter curve there, that red one out there, there's the demand curve, and then there's the marginal revenue curve. So let me go ahead and do just quick math for you. So let's suppose back here that I sell 10 of these at $1. So what is that? That's $10, right? My total revenue is $10. Here, what I can do is I can say something like, well, you know what? If I charge a higher price, say $1.20, well, what's going to happen? I know that I'm going to sell fewer. I know I can sell 10 at $1. But if I raise it to $1.20, maybe I can only sell 9. Oh, so if I sell 10 at $1, my total revenue is 10. But if I sell 9 at $1.20, well, what's 9 times 12? Do I need to get out my calculator for that? What is that? That's 1080. All right, so what happens there? The price goes up to $1.20, and my quantity demanded goes down to 9, but my total revenue is now $10.80. Right? $10.80. So my marginal revenue is only 80 cents. So that's why the marginal revenue curve separates from the demand curve, right? The price is $1.20, but my marginal revenue is only an extra 80 cents. So now when it separates here, this is imperfect competition. We're still going to produce, like we did back here, where the marginal revenue is equal to the marginal cost. But now our price is going to be, look at the marginal revenue curve and that short-term marginal cost curve, which, by the way, I don't think I said this back here. Let me go back here. That marginal cost curve, that is the supply curve. So that should make perfect sense. So it should be upward sloping, at least, once we get past, making 1 or 2 or 3 of these snow cones. So what we do then is that we hit the marginal revenue right up there. We then go up that line, and that's the price. That's P star over there, and that's the optimal quantity produced. So we have an equilibrium here where the marginal revenue is equal to the marginal cost, and then we get that price here. So the key to understanding imperfect competition is the separation of the demand curve from the marginal revenue curve, and that was that example that I just gave you. So what did I say just a moment ago? Take a deep breath, think about snow cones, and if you think about snow cones on the exam, you ought to be able to answer questions on interpret these results for perfect and imperfect competition. The reading then goes on to a section that asks the question, well, what happens if nothing here, nothing good on this graph is happening, but under imperfect competition, what happens if we just can't make any money? What does that mean? What is our shutdown analysis? So this goes back to break even. We're not producing enough to break even. So how do we do this? So here's a good table. You might want to get your phone out and take a picture of this. I love asking candidates to take pictures. So at the end of level 1, you're going to have a little folder on your phone where it's, just call it, CFA pictures from Jim, and you'll go in there, and then when you have a moment and you're riding on the train or you're sitting in the library, you can just scroll through these pictures before you take level 1, and that's going to be a great study guide for you. All right, so short-term, long-term decisions. Some of these we're going to say, let's stay in the market. So if our total cost and total revenue, there we are at the break-even rate, we're just going to stay. We're going to continue producing snow cones. But what happens if our total variable cost exceeds our total revenue? Then in the short term, we're just going to say, sorry, we're closed. We're going to back out of the park and we're going to go home, and we're going to say something like, all right, is there anything else that we can do to come back to change this life? How can we reduce our total variable costs? Maybe we can buy cheaper ice. Maybe we can buy an electric truck, electric vehicle. I'm not sure if that really is going to work. But in the long term, it might. So we may be able to re-enter the market in the long term because we can adjust our costs. That's the important part there. But what if we're somewhere in the middle there? What if we're somewhere in the middle where our total revenue is less than our total costs? Our total costs. What we can do is in the short term, we can just stay in the market. But what if those are greater than our total variable cost? So we're gonna stay in the market for the short term. We're gonna weather the storm, so to speak. And then if this continues in the long term, we're gonna go ahead and get out. All right, so unable to generate economic profits, we need to make some decisions. So this table helps you there. All right, economies of scale. You probably remember this from your undergraduate economics days, where when you produced that very first snow cone, how much did it cost you, that very first one? Well, you had to pay for everything, so that cost a lot. But then when you make your 1,000th snow cone, you spread all of those costs over 1,000 units of production, and so that's an economies of scale. What we're going to talk about at the end of this slide is super important about economies of scale, because when you have companies merging, lots and lots of times you read in the Wall Street Journal, and you should be reading the Wall Street Journal every day. You'll read, oh, this merger is going to result in economies of scale, which means they can produce more at a lower cost per unit. So there's that first bullet point there. So yeah, market information to make more effective decisions, purchasing larger quantities on a discount. You know, this is kind of that third embedded bullet point. That's kind of the Sam Walton model over the years, right? Mm-hmm. Purchasing larger quantities on a discount. Why do goods cost less at Walmart? Because Sam Walton, he has this great purchasing power. He says something like, you know what, I'll buy 1 trillion of those. And so the producers over there, they say, oh my gosh, well, we'll give you a discount. And so Sam Walton can then pass those on to us. Returns to scale, divisions of labor and management, and investing in efficient equipment. So all of this stuff to get put together leads to being able to realize these economies of scale. But then of course, at some point, you might have this risk of diseconomies of scale, which means that when you start producing more and more, that cost per unit goes up. Somehow it goes up because, I mean, you think about it. Let's suppose that in my snow cone example, I can increase my production by adding another worker. So I bring my wife in there. My wife, we're a team. We've always been a team. We've been married for 30 some years. We do great together. So we're a team. So we're more efficient, right? So instead of in that imperfect competition model, instead of selling 100, we can now sell 130 or 180, whatever it is. So I start thinking, well, how about if I hire somebody else? So I hire a bunch of my students. So the third one and the fourth one. And then suppose I have 100 students in my truck. Well, sooner or later, they're going to get in the way. And they're going to reduce efficiency. So there we go, due to decreasing returns. Overlapping and duplicating business functions. This happens, and maybe you guys know this better than I do because you work in the financial institutions industry. But there have been lots and lots of mergers in which, you got two financial institutions merging and they say, oh, we're going to have these tremendous economies of scale. And then a lot of times what happens is they reduce the workforce. And so you got, over here you had one person doing this, one person doing this. So you merge and you only need one person doing that. So after a while, then that one person says, I need help. And so I need to hire another one and another one and another one. And so this duplicating business functions there. And then supply constraints. This is super topical. I know the Institute regularly says, you know what, we really don't pay attention to, any kind of current events. But when those current events are magnanimous enough to bring our attention to certain kinds of items, the Institute, can't help themselves but bring this in. So supply constraints. So what did we experience in 2020 and 2021? We had all these supply chain bottlenecks because of COVID and because of government responses to COVID. And so what did we have here in the United States? We used to wake up every day and see a picture out there in the Pacific Ocean. And there were 1 million cargo ships and they had no place to dock. All right, so remember that supply constraints can lead to diseconomies of scale. All right, 5 key factors. This is a great exam question. So the question stem says something like, here's a market structure, tell me about this, and here are your choices. And so 3 of these could be your 3 multiple choices. So quantity and relative magnitude of firms involved in supplying the product. So think of my snow cone example. We went from having a truck in every space to just one in every corner to a monopoly will be just one truck sitting there, right? So relative magnitude of firms. Yeah, so product differentiation. So this was really important. I didn't say this earlier. I was waiting for this slide. This was really important. Remember I said we're all selling the same snow cones. We all have the same ice. We all have the same syrup that we're putting in there. So what do? Well, market structure, it depends on product differentiation. I mean, I could say that, hey, my ice comes from the North Pole and Santa himself crushed this ice. So these little kids, they're going to say something like, oh, Mom and Dad, I want Santa's ice. Let's go to Jim over there because he has a special relationship with Santa. And if I tell him what a good little dude I've been this year, maybe Jim will tell Santa and I'll get more presents for Christmas. All right, so product differentiation can occur in many different ways. Let me just pause. Look, some of you have my favorite calculator. This 12C, you have to use the reversed Lukasiewicz notation where there's no equal sign on there. Those of you who have the Texas Instruments, you have an equal sign. So there's an example of product differentiation. Yeah, sellers' pricing power. When we have our conversation on the corporate finance topic and we talk about capital budgeting and net present value, we're going to talk about branding, right? What's the goal of the business? The goal of the business is to maximize the value to the owners. How do we do this? By developing branded product lines. If I'm Jim's Chocolate Company and I say, hey, come buy Jim's chocolate bar, you might say, well, maybe I'll taste it, but here's Milton Hershey's chocolate bar. I know Milton Hershey's been making chocolate bars for 1,000 years. I know the quality of that thing. I don't know anything about you, Jim. So branding, right? Pricing power. And then barriers. This has a lot to do with the cost of entry to the market, but then, government influence about how to enter and leave a market. All right, so here are the 4 types: pure monopoly, oligopoly, monopolistic competition, and perfect competition. This is the spectrum that I was talking about earlier. Note less competition and more competition. Man, if the institute gives you a question like that, which of the following has the least amount of competition? Boy, you just run to the monopoly answer and move on to the next question. Maybe you'll get an easy question like that. The institute does give obvious questions away. All right, let's start with perfect competition. And this is pretty much a summary of my snow cone example. Large number of buyers and sellers, a product that is identical, right? We call that a homogeneous product. Perfect information, right? Everybody inside of the park, they knew everything about me and Betty and all the other people, and they knew that we were all selling the same snow cone. Price taker, right? There was that horizontal, perfectly elastic demand curve, no barriers to entry, profit maximization. Yeah, can't influence market price. Examples, agricultural products. I'll go ahead and editorialize here. So put this comment in parentheses. At least here in the United States, agricultural products. There's tons and tons of government intervention and influence and regulations. So much so that in the history of the United States, we had milk producers who were actually pouring milk out into their farms. So anyway, agricultural products. This is a perfect example because corn is corn, right? Wheat is wheat, and you look out in the farm and there's 1 million acres of farmland out there growing corn and wheat. So it ought to be perfect competition, and that's the example that the Institute gives. Monopolistic competition. This is almost like, I don't want to use this term. Don't ever tell your economics professors I said this, but this is kind of like nearly perfect competition, almost nearly, not quite, but nearly. So there's lots of buyers and sellers in the market, but not tons and tons of them. So what happens is we use, there's that word again, branding and differentiation to gain market share. Sellers have some control over that. So that's why we had that separation of the demand curve and the marginal revenue curve, because you can take advantage of branding, and Milton Hershey does this, and Sam Walton does this, of course. There are not substantial barriers to entry, but few barriers to entry. Fast food chains, clothing, etc. A monopoly is a mono, that just means one, right? They are price makers, so there's one producer. And you might be tempted to say something like, if I'm a monopolist, I get to charge whatever I want. But clearly that's not true, right? If I'm a monopoly, if I'm the only snow cone dude at this park, I cannot say to the people, hey, buy my snow cone, $1,000, right? I can't charge $1,000 because the people, they would look at me and they say, wait a minute, Jim, you have to be crazy. $1,000, there's no way it's worth $1,000. Just on pure opportunity cost evaluation. Not to mention that the people would look at me and say, you know what, Jim, we don't like you at all. You're trying to take advantage of the heat around us and think that maybe we'll all get together and chip in a penny and buy one snow cone. All right, so that's not true. So the price has to be, I'm going to put this in quotes, I don't like doing that, but the price has to be reasonable. So look at the bottom, think about your water bill, your gas bill, your phone bill. Do you have cell phones? No, I don't even know if anybody has phones anymore. Cables. And so what happens is that the government says, you know what? There's no way that a municipality, let's just say New York City, there's no way a municipality of New York City could have 300 water producers, because they're going to dig down under the ground and tap into the same aquifer under Manhattan or wherever that New York gets its water from, right? So the government comes in and says, you know what, Jim, you do it over here, and Jen, you do it over there. So there's two people out there. Jim, you have this territory. Jen, you have this territory. So that's kind of like a monopoly. High barriers to entry because, I mean, think about it. What do you have to do to produce water? Well, you need a shovel and you need to be able to dig way down there and you need a pipe. Now that's a super simple example, but you need to make sure that you clean the water, right? You need to make sure the water doesn't have any pollution in it, or it doesn't have any paramecium in it that's going to cause everyone to vomit when they drink it. So, I mean, huge barriers to entry. Single seller, price discrimination. Yeah, so they can decide. Now remember, we're not going to charge $1,000 for a snow cone, but what was that price earlier? It was $1 under perfect competition, and then maybe $1.20 under imperfect competition. So boy, what are we going to do? The monopolist is a good economist. The monopolist says, what's the maximum number that I can charge and still have enough demand to cover all of my expenses? And what we find out is that the way that graph works is that it's fairly easy for the monopolist to accomplish this. So we call these monopolistic profits. Now, the oligopoly is a condition under which the monopolist has some competition. And that competition is not so much as the imperfect competition that we talked about earlier, but there are just a few firms. You might think of it as the 4 trucks on the 4 different corners. So what are we doing? If there's enough distance so that the people have to walk too far, look at the second teardrop point. Pricing interdependence. So we're going to start with that $1. Then we might go to $1.20, but then we might go to $1.30 or $1.50. We're not going to go to the $1.80 for the monopolist profit, but maybe, or the monopolist price, but maybe $1.55, maybe $1.65. So we're going to be aware. We're going to be aware of what those other 3 trucks are charging. Now, barriers to entry are high. They're not as high as they are for the monopolist, but of course, since the products are still the same cone, right, homogeneous, we're probably going to do really, really well over the long term. Yeah, oil and gas, airlines, automakers. Boy, I'm tempted to editorialize there about oil and gas and airlines and automakers, but I won't. You guys read the Wall Street Journal. You know about government intervention and all that. All right, so here's the graph that you've been waiting for. So here's the monopolistic competition. There we go. The demand curve is the blue dotted line. There's the marginal revenue, a little bit steeper. So that's exactly what we were talking about before. But then what's going to happen here? We're going to make a decision. Marginal revenue equals marginal cost. Go ahead and look at the bottom in the green and the blue. So there's our marginal cost. There's our marginal revenue. So that's down at the bottom. But what price can we charge? We can go ahead and charge that price all the way up over and go to the left. That's P1. So that square, P1 over to the demand curve, then the demand curve down to the average total cost curve, then over to C1, that's cost, and then up. That rectangle there, that is the monopolistic competition profits for the industry. Remember, marginal revenue equals marginal cost. So the economic profit, let's go back to, what did we do? Break even in that very first slide or two. So economic profit is going to be total revenues minus total cost. Boy, there's a simple economics and accounting, probably not a finance equation, but economics and accounting equation. But in the long run then, what's going to happen here? This is really important. This is a great exam question. So here we are, we're producing at Q1, right? And that gives us P1. And in the long run, what happens is that P1 and the C1, that's going to be our long run marginal cost curve. So let me go back here. So here we have a steep, we have a, what's that, a V? Can I call that a V or a super smiley face? The red, the short run marginal cost curve has a steeper slope, but in the long run those costs are spread out, so that's why we have that that regular old little smiley face there. And so that's what we're going to do. Now what the learning module does is say, suppose that we increase production from Q1 to Q2, all the way over there to the long run average cost curve. That Q2, that's an important one. That is the point where break-even point is reached. Those profits are going to be equal to 0. So if we get to Q2, nobody's going to be making an economic profit. So there's incentive to stay at Q1 or something less than Q2, so that we can find wealth increasing projects and generate profits over the long term. Yeah, there's that level of pricing interdependence that we talked about. So here, when we have an oligopoly, we can do pricing interdependence, which is exactly what I was saying about the square and the 4 corners. We're always aware of what the other people are doing. So we want to do some things, whether that's a price increase or a price decrease. And if we do decrease the price, then the other 3 trucks are probably going to be aware of that and maybe follow, maybe not. We'll see. 2 interesting economic results that are talked about just ever so briefly in here, but these might be good exam questions. So the Cournot assumption, which is also called the Cournot Model or the Cournot condition, and this is an easy one here. What we're going to do is we're going to determine, here, let me go back here, this optimal level of Q. What we're going to do under Cournot is we're going to say, and we're going to look to those other 3 trucks, and we're going to say they're not going to change their output. So how can we maximize our profits if those 3 trucks sell, whatever it is, 100 a day or 1,000 a day, whatever that is. So this Cournot model says we can do stuff, whatever that stuff is, to try to maximize our profits. Now, the Nash Equilibrium, this is interesting because what we're going to do is we're going to look at those other 3 trucks and we're going to say, you know what? We know what they're producing today, but we don't know what they're going to produce tomorrow. And we know tomorrow that they're going to produce something in their own self-interest. And so we're going to go ahead and make decisions here on ours, knowing that they're going to do the same thing. So those are 2 kinds of different assumptions. Now, you might be tempted to think that, of course, if we have an oligopoly, if we have these 4, doesn't it make sense for the 4 truck owners to meet before the park opens tomorrow and say something like, hey, you know what? I'm making this much profit. You're making this much profit. We're all making this much profit. Wouldn't it be awesome if we could make this much profit? How about if we collude? So what if the 4 of us meet in the morning and we say something like, you know what, let's go ahead and let's agree to behave during the course of the day. Let's go ahead and let's all charge $1.75 today, no matter what happens. Well, is this going to work? Sometimes it works. The number has to be, there can only be 4. Still has to be the snow cone, right? Homogeneous, similar cost structures. Yeah, orders are frequent, regular, and relatively small sizes. Fear of severe retaliation. Yeah, breaking the collusive agreement. But that second to last one, this is the big problem. The big problem is that, sooner or later, if we're charging $1.75, and we all notice that people are buying fewer snow cones, we're going to say something like, I'm going to say, you know what, that Bob over there, I don't trust that Bob over there. Even though we all shook hands this morning and agreed on $1.75, I know Bob is devious over there. He's going to charge $1.65. And Betty's over here, and Betty says, oh, have you seen Jim? Oh, man, he's got those glasses. He's losing his hair. He's old. I know he's going to lower that price. So what happens? All of a sudden, everybody says, I'm going to lower the price to $1.62 or $1.51 or whatever it is. All right, so forget about my little example there. But what this collusion relies on is that we've shaken hands, shaked, whatever the past tense is. We've done that and we have agreed. So severe retaliation, yeah. This is what I was saying earlier about mergers and acquisitions, and how do we determine whether there is going to be the threat of monopoly. And of course, here in the United States, we have the Department of Justice, and they get to agree on whether or not a merger is going to result in an oligopoly or a monopoly or a near monopoly. And so the Department of Justice, they sue and they say, you know what, you two firms, you cannot merge. Well, there has to be some standard. It can't just be a lawyer who works for the federal government who says, you know what, I don't want these two firms to merge, so therefore I'm going to prevent them from merging. No, there has to be some kind of statistics. So we have a concentration ratio. This is super simple. What we do is take the top 3, maybe 4, maybe 5 firms, and we just sum their market shares. So the value can be between 0, perfect competition, and 100%, which would be a monopoly. And you can use that to try to determine if the top 3 firms capture 98% of the market share, well, then that might be those 3, they might act like an oligopoly, or they might combine and collude and act like a monopoly. Now, what example did I give? High 90%, that's an obvious one. But suppose the top 3 or 4, they get to be 30% or 40% or 60%. Where's the cutoff, right? How do you decide whether 40% is too big or 60% is too big or 80%? How do you determine? So the concentration ratio, it has that limit that you can't really tell, and you have to have some arbitrator come up with a number. And in addition to the simple fact that you ignore firms 5 and 6 and 7, 8 and 9 and 10, right? So to include all firms, back in the 1940s, these 2 dudes, one was a German dude, one was a US dude, the Herfindahl-Hirschman Index, what they simply did is they squared the market share of all the companies there. Highest value, of course, is 1. Let's do a quick example here, and then I'll tell you a little bit more. So we can do this here. Top 2 suppliers, 20 and 30%. Concentration ratio would be 50, and the HHI would be 0.13. And so what you can do for both of these is you can do just the top 2, or for the HHI, you typically do a whole bunch of them, maybe the entire market, although that's probably not too realistic to go ahead and capture. But let me go ahead and give you just a little bit of history of math. Remember in that first topic in level 1, we talked about the Euler's number, where we did 1 over 1 factorial plus 1 over 2 factorial plus. And we got that little e raised to the x number, 27183. Remember, we did all that stuff. Well, there are a lot of tricks that you can do in math, and one of them is just to square a number. And so what this does, the squaring of the number, it allows for a measure of the relative strength of each of those firms. And so that's really what the decision comes up to. So that takes us through all of these LOSs. What I want you to do now is take 10 minutes or so. I think there are 13 questions at the end of this learning module. They're pretty straightforward. You should be able to get through most of those relatively easily and with a high degree of accuracy. So, hey, thanks for watching, and good luck studying.